You can imagine the American economy is an economic train moving down a track that has no ending. And it picks up cargo and passengers as we go along. There's 330 million of us now, and there were only 4 million in 1790. And our farms are incredibly more productive, and we have 75 million houses, and we had a few huts then, and we have great universities and all of these things. So we're just constantly moving more and more cargo and passengers along. And occasionally, that train is going to get derailed. If I knew what the next crisis would look like, I could probably, might be a little bit helpful in stopping it. But there will be other crises. There's no way of knowing when you're in a situation like we were in the fall of 2008 or 9, when or precisely how it will end. You know the United States will come back. The factories don't disappear, the farmland doesn't disappear, the skills of the people don't disappear. But you had a system which was going to put them all in an idle position, or could do it, and there's no way of knowing how far it was going to go. What's left from the crisis is pretty much our memories. I mean, the tracks are still there, the train's still there, but we had a big interruption in 2008 and 9, and now the train has been running pretty darn well, and we've shown that America can't be stopped.
Market crashes often cause fear, leading to poor decisions that can harm portfolios. But what exactly should an average American investor do during a market crash? And what are the worst mistakes to avoid? In this video, we will explore Buffett's strategies and provide actionable advice for investors facing a market crash. Warren Buffett, one of the most successful investors ever, is known for staying calm and sticking to long-term strategies, even during market crashes. His approach is based on fundamental analysis, understanding market cycles, and believing in the economy's long-term growth. One of Buffett's core messages during a market crash is to avoid panic selling. Historical data supports this advice. For example, during the 2008 financial crisis, the S&P 500 dropped by over 50%, and those who sold their assets in panic locked in those massive losses. But those who held on saw the market recover and eventually reach new heights within a few years. Panic selling often results in realizing losses that could have been avoided with patience. When investors panic sell, they essentially turn paper losses into real losses, missing out on the potential recovery that typically follows a downturn. Buffett's investment in Coca-Cola during the 1987 market crash is a perfect example of staying calm during turbulent times. Instead of selling his positions, Buffett took advantage of the lower prices and increased his stake. Today, that investment is worth billions. Coca-Cola stock remains one of Berkshire Hathaway's biggest holdings today. According to CNBC's Berkshire Hathaway Portfolio Tracker, which tracks the company's latest 13F filing, the holding company owned a 9.3% stake worth more than $27.6 billion in the company as of June 30, 2024. Its 400 million shares also make it Coca-Cola's largest single shareholder. The lesson here is clear. During a crash, focus on the long-term prospects of your investments rather than short-term price movements. Market crashes can offer great deals on high-quality assets, but you need to stay calm and not sell. The average bear market lasts 9 months. And according to Forbes, since 1957, the average bull market has lasted nearly 5 years and generated an average S&P 500 return of more than 169%. Bull markets have typically performed best during the first year following the previous bear market bottom, averaging a 41.8% gain. This statistic highlights the importance of patience. While market downturns can be painful, they are often short-lived compared to the extended periods of growth that follow. These numbers demonstrate the resilience of the market and the importance of maintaining a long-term perspective during short-term turmoil. Another example of the dangers of panic selling can be seen in the aftermath of the dot-com bubble. Many investors who sold their stocks at the bottom of the market missed out on the subsequent recovery. By 2003, many of the companies that had survived the bubble were experiencing significant growth, and those who held onto their investments were rewarded. Buffett's strategy of staying invested during downturns is rooted in the belief that the market will eventually recover. Despite numerous crashes and recessions, the S&P 500 has averaged 10% annually since its inception. For average Americans, this means sticking to your investment plan, even while the market is volatile. If you're investing for retirement or other long-term goals, pulling out of the market during a crash can be detrimental. The market's best days often follow its worst, and missing out on these days can significantly impact your overall returns. Research shows that missing out on just a few of the market's best performing days can drastically reduce your investment gains. For example, if you had invested $10,000 in the S&P 500 in 1980 and stay invested through all the market crashes, your investment would be worth over $700,000 today. However, if you had missed just the 10 best days in that period, your returns would have been reduced by more than half. When you stay invested, your returns compound over time, leading to exponential growth in your wealth. This is particularly important for long-term goals such as retirement. By pulling out of the market during a downturn, you not only lock in losses, but also miss out on the compounding effect of your investments during the recovery phase. Buffett often reminds investors that timing the market is more important than timing the market. The stock market can be unpredictable in the short term, but over the long term, it has consistently trended upwards. By staying invested, you allow your money to grow and benefit from the market's long-term trajectory. This is why Buffett advises against making rash decisions during market crashes. Instead, he encourages investors to maintain their focus on their long-term goals and to trust in the market's ability to recover. One of Buffett's favorite strategies is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market's performance. DCA is particularly effective during market downturns because it allows you to buy more shares when prices are low, reducing your overall cost per share over time. By consistently investing, you smooth out the effects of market volatility and reduce the risk of making poorly timed investments. By consistently investing, you avoid the emotional pitfalls of trying to guess market movements. DCA takes the guesswork out of investing and helps you stay disciplined, even when the market is experiencing extreme volatility. The chart shows two hypothetical investments in the S&P 500 over the 20-year period ending December 31, 2023. Each investor contributed $10,000 every year. One investor somehow managed to pick the very best day, the market low, of each year to invest. The average annual return on that investment would have been 12.64%. The other investor was not so lucky and actually picked the worst day each year. Even with the worst investment timing, the average annual return would have been 10.78%. At the end of the 20 years, the cumulative investment of $200,000 had a value of $640,469. So even selecting the worst day each year to invest, someone who continued investing in the market over the past 20 years would have come out ahead. Another advantage of dollar cost averaging is that it helps you avoid the emotional stress of market fluctuations. When you invest in a lump sum, it can be disheartening to see your portfolio value drop significantly during a market downturn. However, with DCA, you know that you're buying more shares at lower prices, which can help alleviate the psychological impact of market declines. This disciplined approach to investing is one of the reasons why Buffett advocates for it, especially during times of uncertainty. Buffett also emphasizes the importance of diversification, especially during uncertain times. While Buffett himself often invests heavily in a few key stocks, he acknowledges that for most investors, spreading risk across different asset classes is essential. A well-diversified portfolio can help reduce losses during a downturn and provide more stability. Diversification reduces the impact of any single investment on your overall portfolio, which can be particularly important during market crashes when certain sectors may be hit harder than others. For the average American, this might mean holding a mix of stocks, bonds, or other assets such as real estate or commodities. During a market crash, some asset classes may perform better than others, helping to offset your losses. For example, during the 2008 crisis, bonds and gold outperformed stocks, providing a cushion for diversified portfolios. This highlights the importance of having a balanced portfolio that can weather different market conditions. A balanced portfolio with 60% stocks and 40% bonds has historically provided a good mix of growth and stability. During the 2008 crash, such a portfolio lost significantly less than an all-stock portfolio and recovered faster. This is because bonds typically perform better during economic downturns, acting as a counterbalance to falling stock prices. By holding a diversified mix of assets, you reduce the overall volatility of your portfolio and increase the likelihood of achieving consistent returns over time. While the U.S. stock market has historically been a strong performer, other markets around the world can offer different growth opportunities and risk profiles. By diversifying internationally, you can reduce the impact of any single country's economic performance on your portfolio. This global diversification can provide additional protection against market volatility and help you achieve a more balanced portfolio. Buffett's success is partly due to his deep understanding of market cycles and economic indicators. He pays close attention to factors such as interest rates, inflation, and corporate earnings, which can provide clues about the market's direction. For the average investor, it's important to understand that the stock market goes through cycles of boom and bust. Recognizing this can help you stay calm during downturns and avoid making rash decisions. Economic indicators such as GDP growth, unemployment rates, and corporate earnings can provide context for market movements, but they shouldn't dictate your investment strategy. Instead, these indicators should be used to inform your understanding of the market and to help you make more informed decisions. During the 2020 pandemic-induced recession, the GDP contracted sharply and unemployment spiked. However, the stock market rebounded quickly due to unprecedented fiscal and monetary support, showing the complex relationship between the economy and the stock market. Since 1950, there have been 10 bear markets, but each was followed by a bull market that more than compensated for the losses. By understanding the factors that drive these cycles, you can make more informed investment decisions and avoid the common mistakes that many investors make during market downturns. Warren Buffett advises against holding cash or low-yield bonds during inflation, as they lose value. Instead, he prefers stocks, real estate, and commodities that can grow and preserve purchasing power. With the U.S. facing rising inflation due to government debt, Buffett suggests preparing by investing in assets that keep up with inflation. Historically, during the 1970s, stocks and commodities outperformed cash and bonds, showing the importance of diversification to protect wealth in inflationary times. Inflation has averaged 3.22% annually in the U.S. since 1913. Over the same period, the S&P 500 has returned around 10% per year, showing that stocks are a good hedge against inflation over the long term. While inflation can erode the value of fixed income investments, stocks have historically provided a strong defense against inflation by generating returns that outpace the rate of inflation. This is why Buffett advocates for a long-term investment strategy that includes stocks, even during periods of high inflation. The current debt crisis in the U.S. also poses potential risks for investors. As government debt continues to rise, there is increasing concern about the sustainability of current fiscal policies. However, Buffett believes that the market will continue to grow over the long term, as inflation helps to reduce the real value of debt and drives asset prices higher. Crashes are a natural part of the market cycle, and those who stay the course are often rewarded with strong returns over time. Considering today's circumstances, if you want to know how Buffett would invest $1,000, then watch this next video.